Hi, good morning everyone. Welcome back to Value.Venture. In the previous video, we established what the developer is actually approved to construct. Now comes the next question. How much will it realistically cost to develop and complete that project? This is called the total project cost or TPC. And in construction finance, we should never simply copy the TPC from the developer's presentation or financial model. The cost needs to be broken down and tested head by head. There is also an important distinction here. Total project cost and lender eligible project cost may not always be the same. A developer may treat certain expenses as part of the overall project cost, but the lender may not necessarily recognize every expense for financing purposes. So, from the very start, we separate what the project costs from what the lender will actually fund. Let us start with the first major component, land or development right cost. If the developer has purchased the land outright, the documented acquisition cost and directly attributable expenses may be considered, subject to the lender's policy. But in a joint development agreement, the developer may not have purchased the land at all. The consideration to the landowner may instead be through area share, revenue share, security deposit, corpus, or other contractual terms. So, land cost in a JDA should never be inserted mechanically. We first need to understand the actual transaction structure. The next major component is the construction cost. This may include RCC, masonry, plastering, waterproofing, flooring, doors, windows, painting, and other civil works. Then come MEP and specialized services, electrical, plumbing, firefighting, lifts, and other building systems. The technical valuer should check the construction rate against the approved area, the project specifications, contractor quotations, or BOQs where available, current execution conditions, and the site status. And for every cost head, three questions are useful. Is the quantity correct? Is the rate reasonable? And how much has already been incurred and how much is still required? Next comes external development and infrastructure. This may include internal roads, drains, STP, WTP, where applicable, transformer and electrical systems, water infrastructure, compound walls, landscaping, and site development. Then we have the soft costs: architect fees, structural and MEP consultancy, PMC charges, statutory expenses, professional fees, administration, marketing, contingency, and finance cost, depending on the lender's eligible cost definition. Now, another important technical check is duplication. Suppose the developer's composite construction rate already includes electrical and plumbing works. If MEP is then added again separately, the project cost may be overstated. Similarly, if contractor overhead and profit are already included in the contractor rate and are added again as a separate cost head, there may be double counting. Area consistency should also be checked. If construction cost is calculated on 2 lakh square feet, but the technically accepted construction area is only 1,80,000 square feet, we need to understand the reason for that difference. Another useful classification is this: cost incurred and paid, cost incurred but still payable, cost committed but not yet incurred, and future cost required to complete. This matters because cost incurred and cash paid are not always the same. A contractor may have completed the work, but part of the bill may still be unpaid. That amount remains a cash obligation, but the same cost should never be counted twice. We should also compare the reported cost incurred with the actual physical progress at site. If the developer reports 60 crore has already been spent, we need to see whether that expenditure is reasonably supported by the construction, materials, and infrastructure already completed. Finally, the project cost should broadly reconcile as total project cost equals verified cost incurred till date plus balance cost to complete, and both sides should relate to the same approved project scope. Why does all this matter? Because an understated TPC can hide a future funding gap. An overstated TPC can exaggerate the funding requirement, and an overstated cost incurred can make the project's funding position look stronger than it actually is. So, TPC verification is not just about adding up numbers. The valuer should establish whether the cost is complete, reasonable, free from duplication, consistent with the approved project, and sufficient to take the project to completion. Once the total project cost is established, the next question is how much of that cost has actually been incurred and does it match the physical work completed at site? That is what we'll discuss in the next video. Please subscribe to Value Venture for more such videos. Thank you for watching.